Right now, as we look at the live tape, Opendoor Technologies Inc. is trading at exactly $7.76, currently up roughly 6.5 cents or 0.85% in today's session as of this morning. Seeing a green number like this on a stock that has been a battleground for nearly 3 years might tempt you to think the worst is over, that we are simply witnessing a standard recovery in the housing sector. The expectation from the casual observer, perhaps someone who just browses Zillow or watches HGTV, is that Opendoor is merely a digital house flipper, a company that lives and dies by the simple spread of buying low and selling high. They expect that as interest rates stabilize, the iBuying model will return to its 2021 glory days. But the reality we are dissecting today is fundamentally different and far more volatile. We are not just looking at a real estate company, we are looking at a company undergoing a radical refounding into what they call Opendoor 2.0, an aggressive pivot that attempts to replace human intuition with AI-native execution. The reality is that this stock is no longer just a bet on housing turnover. It is a high-stakes derivative trade on the success of an automated financial engine, complicated by a weaponized corporate action involving tradable warrants designed to squeeze short sellers. The intraday movement we are seeing, that steady hold above the 770 level, is deceptive. It masks a violent undercurrent of institutional repositioning. You might be watching this on your Fidelity mobile app or through your interactive broker's trading screen, seeing the volume tick over and thinking this is accumulation. But you have to look closer at the structure of the trade. The recent issuance of tradable warrants as a special dividend was not just a reward for shareholders, it was a tactical nuke dropped into the capital structure. By issuing warrants that trade separately, often under tickers like Open.W, management has effectively created a multi-layered game of chess. Short sellers, who have plagued this stock since its SPAC days, are now forced to navigate a complex delivery requirement. This technical dynamic is creating a floor under the stock price that has nothing to do with how many houses they sold yesterday and everything to do with market mechanics. For those of you engaging in self-investing, perhaps managing a small-cap allocation in your Fidelity IRAs or individual brokerage account, this is the kind of setup that demands your full attention. The expectation is that Opendoor is a distressed asset, trading at a discount to its book value. The reality is that it is an option on a binary outcome. Either the new AI native model works and reduces their operating costs by 50%, sending the stock to $20, or it fails, and the cash burn accelerates, pushing them toward a restructuring. There is no middle ground here. Comment below how many shares of Opendoor you currently hold, and more importantly, did you receive the tradable warrants? I want to know if you are holding them as a lottery ticket or selling them for immediate cash. Let's dig deeper into this Opendoor 2.0 narrative because it is the engine of the current price action. The new CEO, Kaznajacin, has explicitly stated that the old Opendoor, the one with armies of estimators, inspectors, and support staff, is dead. The new Opendoor is a software company. The expectation from the market was a slow drift towards efficiency. The reality is a brutal rapid slash and burn of manual processes. They are betting the entire company that large language models and computer vision can price a home better and faster than a local real estate agent. If you are using online investing tools to screen for PropTech, you usually find companies that just make websites. Opendoor is trying to operationalize AI in the physical world. If their algorithm misprices a home by 5%, they don't just lose a user, they lose $50,000 of actual capital. This execution risk is what keeps the price pinned at $7.76 instead of $15. The recent Q3 25 earnings report gave us a glimpse into this transition. Revenue came in around $915 million. While some headlines screamed miss, the more important metric was the contribution margin. Are they making money on the unit economics? The answer is sort of. They are clearing out old inventory, the bad vintage homes bought when rates were volatile, and replacing them with new inventory under the new AI underwriting standards. The market is currently in a show me phase. It is waiting to see if the Q4 and Q1 numbers reflect this improved margin. If you are watching Apple stock or Nvidia stock, you are used to seeing margins expand as scale increases. In real estate, scale can actually hurt margins if you're not careful, as Opendoor learned the hard way in 2022. The reality here is that Opendoor is shrinking to grow. They are buying fewer homes, but trying to make more profit per home. This is a disciplined approach that is foreign to the growth at all costs mantra of Silicon Valley. And it is confusing the algorithms that run Schwab Intelligent Portfolios and other automated trading systems. We must also talk about the macro environment, because Opendoor does not exist in a vacuum. The housing market is currently stuck in a lock-in effect. Homeowners with 3% mortgages are refusing to sell and swap for a 6% or 7% mortgage. This has decimated transaction volume. The expectation is that the Fed will cut rates aggressively in December 2025 and into 2026, unlocking this supply. If that happens, Opendoor is positioned like a bucket waiting for rain. A surge in transaction volume is pure profit for them because their platform is built for volume. However, the reality is that rates might stay higher for longer than the optimists on Robinhood stock trading forums believe. If the 10-year Treasury yield spikes again, that bucket stays empty. The stock price today reflects a probability-weighted average of these two futures. Let's look at the institutional flows. When you check Interactive Brokers platform data, you see a divergence. Some deep value hedge funds are starting to nibble, attracted by the cash on the balance sheet and the turnaround story. They see a company trading at a valuation that implies bankruptcy, which they believe is unlikely. On the other hand, traditional real estate funds, the ones that hold Fidelity ETFs focused on REITs, are staying away. They view the AI pivot as a desperate Hail Mary. This battle between value investors and sector specialists creates the volatility we see every day. A 1% move like today's is just the noise of this battle. For those of you using the Robinhood app or SoFi Active Investing, the tradable warrants I mentioned earlier are a critical piece of the puzzle. Warrants are essentially call options issued by the company. They give you the right to buy stock at a certain price in the future. By giving these to shareholders, Opendoor has effectively diluted the potential future equity but rewarded current holders. It is a way to say, stick with us, and if we win, you win double. It also creates a nightmare for anyone shorting the stock, as they may be liable to deliver those warrants. This short squeeze mechanics is a technical catalyst that can drive the stock up regardless of the fundamentals. It is financial engineering at its finest, or worst, depending on your perspective. Let's pivot to the customer experience, which is the actual product. In the world of investing sites and reviews, Opendoor's reputation is mixed. Sellers love the speed, they hate the fees or the spread. The new AI model promises to tighten that spread, making their offers more competitive with the open market. If they can get to a point where their offer is only 1 to 2% below fair market value, the convenience factor makes them a no-brainer for millions of sellers. This is the Amazon moment for real estate. Amazon started by losing money on shipping to build a habit. Opendoor is trying to build the habit of selling your home in a click. If they succeed, the $7.70 price tag will look ridiculously cheap in 5 years. But changing consumer behavior, especially for the largest transaction of their lives, is incredibly difficult. The competition is also fading, which is a bullish reality often overlooked. Competitors like OfferPad are struggling, and Zillow exited the iBuying business years ago. Opendoor is effectively the last giant standing in this arena. This survivor bias is real. If the iBuying model works at all, Opendoor will be the winner. They have the data, the brand, and the capital. Being the monopoly in a niche market is a good place to be, provided the market actually exists. If you are a user of the